Hey everyone, and welcome back to my channel where we discuss everything related to investing. It's been a wild ride in the banking sector lately, with multiple banks filing for bankruptcy. The collapse of Silicon Valley Bank has sent shockwaves through the financial industry and has major implications for the broader market and economy. In this video, we'll talk about whether there will be more bank defaults in the future. But first, we need to know that one of the main reasons that caused the recent wave of bank defaults was the interest rate hike cycle initiated by the Federal Reserve. Therefore, before answering whether there will be more bank defaults in the future, we need to first examine whether the monetary policy of the Federal Reserve will change due to these recent events. First, if Fed want to change the monetary policy based on the bank defaults of Silicon Valley Bank and other banks, several prerequisites that are currently difficult to achieve must be met. The first prerequisite is that the massive and sustained run on banks will continue to push up the demand for bank reserves, ultimately causing the federal funds rate to exceed its upper limit. In this case, due to the shortage of bank reserves, the Federal Reserve's balance sheet reduction process will be temporarily suspended or slowed down. However, we know that the Treasury Department and the Federal Reserve have been very active in responding to this recent crisis, so the possibility of a massive run on banks in the short term can be ruled out for now. Moreover, the overnight repurchase assets accumulated in the money market fund currently amount to as much as $2.2 trillion, which can meet the additional reserve needs of commercial banks, providing sufficient buffering for the Federal Reserve's balance sheet reduction. Another prerequisite that could affect the Federal Reserve's policy pivot is the possibility of a significant credit contraction that could trigger a collapse in the real estate and stock markets. This corresponds to the risk of deflation and economic recession, which could ultimately force the Federal Reserve to shift towards a loose monetary policy. However, currently both household debt and the trading leverage in the real estate market are at relatively low levels comparing to 2008. For example, the household debt to GDP for United States is at a low point of 76% over the past 20 years. Moreover, if the Federal Reserve starts reducing interest rates now, inflation could rebound, leading to even more serious consequences in the future. Furthermore, the Federal Reserve has already factored in the possibility of an economic recession when raising interest rates. Essentially, the Federal Reserve may only cut interest rates when there are signs of a recession in economic reports, or when deflation occurs. Although the recent series of defaults has earned a lot of attention, it is not enough for the Federal Reserve to immediately abandon its stance of suppressing inflation based solely on the defaults of some small and medium-sized banks. After all, suppressing inflation is their long-term primary task, so they will not immediately loosen or lower interest rates. However, considering the liquidity problems of many banks in the United States, the Fed will certainly slow down the rate and pace of future interest rate hikes. It may even temporarily stop raising interest rates, observe the situation, and then continue to raise them gradually. Although the contagion of the Silicon Valley Bank event is certainly not as great as that of Lehman Brothers, its impact cannot be underestimated. During the pandemic, many banks in the United States experienced an increase in deposits, but a lack of demand for loans, which meant they had to find investment channels outside of lending. This led to many banks, especially small and medium-sized ones, having serious mismatched maturities issues similar to Silicon Valley Bank, and the securities they bought at low interest rates are now heavily discounted in a high interest rate environment. This has caused them to face significant unrealized losses on their holdings. Therefore, although large banks and the banking industry as a whole can still hold up, we cannot ignore the contagion of the SVB incident. During a rising interest rate cycle, if market panic occurs, these banks may continue to be run on, leading to continuous defaults. However, many large banks now lack the individual characteristics of Silicon Valley Bank. In addition, the Federal Reserve has rich experience in rescuing the market, and they have already taken timely and positive remedial measures this time. Therefore, apart from the possibility of small and medium-sized banks continuing to go bankrupt, the overall banking industry in the United States currently does not have too many problems. Although everyone can relax temporarily, the impact of this series of bank failures will still emerge one by one. For example, since last year, the performance of many internet technology companies has not been good. Major technology companies are cutting expenses and laying off employees one after another, and the bankruptcies of banks such as SVB may continue to exacerbate this phenomenon. In the future, many startups that cannot withstand stress tests may have a hard time and may even go bankrupt one after another, which will ultimately have a negative impact on the real economy in the United States. Of course, compared to the dot-com bubble in 2000, the profitability of American technology companies is much better now. Especially the fundamentals and financial strength of large technology companies are very healthy. The transparency and authenticity of financial statements of technology companies now are also much better than in 2000. These giant tech companies can continue to constantly merge, acquire other competitors, perform share buyback, and create a wild moat that's stronger than before. Therefore, it is possible to bottom fish for high-quality growth stocks in the bear market, but you must choose companies that can achieve non-GAAP profits, have positive free cash flow, and have enough cash to consume at least 2 to 3 years of growth. Companies with only stories but no financial strength should not be selected now because the occurrence of black swan events is common during the rate hike cycle. Therefore, while bottom fishing in the bear market, it is also necessary to prevent uncontrollable risks as much as possible and control positions well. After all, we can only have the chance to embrace the next genuine bull market if we successfully navigate through current wave of interest rate cycles. If you have other opinions, let's comment below. Please help to like and subscribe.